All right, welcome everyone. Good morning. Today we have Simon Glossner who will be presenting Where Do Institutional Investors Seek Shelter When Disaster Strikes? Evidence from COVID-19. As a reminder, during the seminar, feel free to type your questions into the chat box or raise your hand using the Zoom function. And at periodic intervals, I will sort of forward those questions to Simon. Simon, the floor is yours.
Okay, thanks so much. I would like to welcome everybody for the seminar today. And the paper is about institutional investors and retail investors. And we look at the COVID pandemic. And it's a joint work with Pedro Matos, Stefano Ramelli, and Alexander Wagner. And Pedro is also on the call here. So in case you have any questions, he will also help me out, and we try to answer all of them. And feel free to ask at any time a question if you have any. I think there is enough time to get to all of your questions. So to motivate the paper, the main question we examine is, what is the behavior of investors when a tail risk event realizes? And by a tail risk event, in this case, we look at the COVID pandemic. And to motivate this, so why do we look at institutionals? I mean, institutional investors have a market share of over 75% by now in US companies. So they are the majority owner of most public companies. And from a theoretical perspective, there could be two different views. On the one hand, you could have a flight to quality, a fire sales channel that all investors go into one, basically overreact, and there's a flight to quality, and they become very risk averse. Or it could also be the opposite, that they are contrarians, and meaning that they see through the crisis, they stay calm. And that's the motivation to look into this, but we'll talk more about this in a minute. And why do we look at COVID? The advantage of COVID, at least from a research perspective, is that it's a completely unprecedented exogenous shock. So there was no one had this kind of risk on their, expected this kind of risk. Most companies didn't identify a pandemic as a material risk. And the same goes for investors. So it's completely exogenous. It did not originate from changes in the underlying economic conditions. So that's different from what we had in the global financial crisis in 2008, because the global financial crisis arose more slowly from frictions in the financial markets. And some players were able to position themselves to see that there's a bubble going on, maybe. Whereas now in COVID, it's a completely new type of shock, a shock unrelated to economic conditions. And that makes it a perfect opportunity to see, how do investors react? How do investors change their behavior when there is a completely unprecedented shock? And to give you some motivating evidence, on the right side, you see a figure. And in the figure, we look at the evolution of coefficient on institutional ownership, and we regress the cumulative returns over an increasing time period on institutional ownership. And then we want to see what is the effect of institutional ownership on the stock prices, on the stock returns during the first quarter. And what you basically see is that the first red line is where the pandemic basically unfolded. The February 24th was the day, or one day after Italy started to intervene because of the pandemic. And the second red line you see is March 23rd. And that is the time when the Fed intervened and increased the liquidity in the market and started to buy bonds, corporate bonds. And in between the two red lines, you see a stark decrease in the coefficient of institutional ownership. And that means that in the stocks that were held by a lot of institutional owners, they had a very large stock price drop. And that is the start of the, like, this is our motivating picture, because we noticed that when you have a lot of institutional owners, you had a worse stock performance in the fever period. What Ramelli and Wagner called it in their paper, the fever period between the two red lines, the month where all the action started. And we basically try to understand, like, why did this happen? Why did stocks that were held by institutional owners, why did they perform worse on the stock market during this time? Was this driven by fire sales or something else? That's basically the main question that we address in the paper. So to talk a little bit more about the theory, the main question is, how do investors react when a tail risk event realizes? And you have two views that could happen. The first is, we know from previous literature that institutional investors, they improve the market efficiency. They make stock prices more informative. And this is also, you expect this to some kind, because institutional investors are sophisticated investors. They are the professionals that get paid to do to manage assets. And we know that they make stock prices more efficient. For example, there's the Bay et al. Paper 2016. And then we also know from other papers that institutional ownership also improves corporate outcomes. It improves, for example, corporate governance. And this kind of view on the institutional investors would predict a contrarian behavior. Because you could expect that maybe COVID at some point will pass by. So you could stay calm and see maybe the long-term picture that would predict contrarian behavior. Now, on the other hand, there could also be fire sales externalities. And Stein said this in a paper in 2009. When institutions enter the same trade and deleverage basically at the same time, then that would create a fire sales externality, meaning that the stock price goes down, and goes down even more than what the fundamentals of the company would suggest. So basically, that there is this flows-driven, stock price demand-driven externality that leads to large stock price drops. And there could be two ways how this happened. I mean, on the one hand, there could be institutions that face outflows from their clients. The clients ask them their assets back, and those investors have to sell. Or it could also be that institutions sell because they are risk averse, not so much because of outflows, but they are risk averse. They don't want to underperform versus the competition, so they sell and become very risk averse in terms of higher volatility.
Simon?
Yes?
Vikas has a question.
Okay.
Yeah,
Vikas.
hi. The challenge here is that the COVID is affecting the stock returns as well as the institutional ownership simultaneously, right? Because there could be fundamental changes in the firm because of the shock. And at the same time, the ownership is also being affected. So how does that sort of affect what you're going to be actually doing?
Yeah, that's in fact that's a good point. So of course there will be effects on the company fundamentals. We try to disentangle this by looking at portfolio characteristics. I will get to this in a minute, but we basically, I mean, it's a problem, that's for sure. So we need to make sure that it's not an unobserved heterogeneity that is driving this effect. But we look into portfolio characteristics, and one finding that we have is, for example, that if a company holds more, if an investor holds more highly leveraged firms, then those stocks perform worse. So we look at the portfolio of the investor, and if you find the investor is more exposed, meaning he has more high leverage firms, then those stocks perform worse on the stock market. So we try to look at investor heterogeneity to identify this.
That's interesting. So I'll wait to see that. But there is also the issue of whether it's how the cash flow is affected and how is the discount rate affected for the pricing of the stock. So essentially, what's really how does this COVID affect the numerator and the denominator? So you're going to basically deal with that as well in your tests.
We focus more on the institutional side and look at the portfolios of how the ownership structure affects the company. We control, of course, for some fundamentals, but those are slower moving. That's a concern. But I will talk more about this when we get on the portfolio interaction.
Thank you,
Simon.
Yes.
Another question from Jerry.
Okay.
Jerry asks, how do you distinguish contrarian behavior from managers expecting Fed intervention?
It's on the point here is we try to, I would say we do the same again. So we look at the portfolio characteristics and see if there are portfolio driven changes that would suggest a fire sales channel. But of course, it's very difficult to see if the managers expect any Fed intervention or not. But we try to identify a fire sales channel through portfolio characteristics and to looking into how change the portfolio, how do the investors change their portfolio, how risk averse do they become, and then to some extent this reflects also, do managers expect Fed interventions? Do they stay calm, or do they get very risk averse?
Ran Singh asks, do you distinguish fire sales from flight to safety in this paper, or regard them as the same channel?
There are two different parts in the paper that we look at. So we look at the stock prices and how do institutional investors affect the stock prices. This is basically where we try to find out if institutional investors exacerbated the stock price drop. And in the second part of the paper, we look at how do institutional investors change their portfolio. And there is where we try to see if there is a flight to safety. Which stocks do they hold? Do they hold more safer stocks, meaning stocks that have high cash, stocks that have low leverage? And that's in the second part of the paper where we look at actual changes in the holdings of institutional owners.
Okay, I think that's all the questions I have so far.
Then I will continue. So on the theory is like the first part is there could be contrarian behavior by institutional investors that are sophisticated investors, or there could be fire sales externalities, and that could be the flight to quality. Like you could have fire sales, or at the same time, there could also be a flight to quality behavior. Like you could basically adjust your portfolio in two ways. First, you could basically engage in a fire sale, you reduce your total equity position, or you change the weights of your portfolio. You move from high leverage firms to low leverage firms, for example. That's the flight to quality. So to give you a quick overview over the paper, and I hope that clarifies some of the question that you had. So we have four main questions, and the first is, was institutional ownership affected by the stock price crash? So we look at, do companies that have a lot of ownership, do they have a lower stock performance or not? And we find yes, US stocks with higher ownership performed worse, and in particular those companies that were held by more active investors, more short-term investors, and that's the important part, also more fragile investors, meaning investors that hold a lot of high leverage stocks, or that hold a lot of stocks with low cash, those companies performed worse. So we have evidence on the investor level that they are more exposed to risk, and those stocks, like stocks that have those owners, they perform the worst. On the second question, that's where we try to find out for those investors that changed their portfolio, how did they change their portfolio? Was there a flight to quality, or did they basically did not change anything and just continued? And what we find is that the selling was not indiscriminate, meaning that institutions valued especially hard financial resiliency, so they moved into stocks with high cash, low leverage, rather than soft characteristics. So ES, environmental, social, and governance scores weren't as important than hard financial resiliency measures of the company. And we also look into different types of institutional investors. So we look into hedge funds and like disentangle hedge fund behavior from mutual fund, investment advisor, pension funds. And our finding is that especially hedge funds, they sold stocks indiscriminately. They do not move into high cash, low leverage firms. They basically just reduce their overall equity position, and they sold over 100 billion. And we do not find the same for other investors. Other investors were more repositioning their portfolio into high cash and low leverage firms. And then finally, we ask, okay, we know that institutional owners led to a stock price drop, to a large stock price drop. And we know that there was a flight to quality, especially in high cash, low leverage firms. And then the question is, who took the opposite side, or was there anybody who took the opposite side? And the ownership percentage, which you can get the retail ownership out from, is 100% minus total ownership. You get an approximate measure of retail ownership. And we bring additional data to show that retail investors, in fact, took the opposite position, especially from Robinhood users. So we bring data from Robinhood users from the Robinhood trading app, and we find that Robinhood retail investors had a high interest in financially fragile firms, meaning they were buying companies with high leverage and low cash, and in some sense they were providing liquidity. And then the last question is, how did these effects in the first quarter of 2020 change in the second quarter? Like, was the second quarter where we saw stock price increases, that the S&P 500 basically reached to their old level? And how did these pricing effects change in the second quarter? And what we find is that institutional owners did not reverse their risk-averse strategies. They're still buying low leverage and high cash stocks. And we also find the same for retail investors. Retail investors do not change their position. They are still interested. They are still showing very risk-seeking behavior by investing, especially in companies that had high leverage and low cash. Are there any questions on the main results?
None yet. Please continue.
Okay, then I will continue. So we contribute to 3 different strands of literature. The first strand is to institutional investor behavior during a crisis event. How do investors react in a crisis? And we know from a paper from Koval and Stafford that there is the problem of fire sales. When institutional investors face a lot of outflows, there could be fire sales, which affect the stock price and lead to a decoupling between the stock price and the underlying firm fundamentals. Then we know that mutual funds hold cash as a response to buffer these kind of risks. And we know also that institutional investors they contribute to financial fragility. But on the other side, there is some evidence, as I said before, some evidence that institutional investors also make the stock prices more informative. So that's the first. I see there's a question.
Yes, Francesco Franzoni notes that your results on hedge funds resonate strongly with the evidence in his paper on the great financial crisis.
Yes, we basically, I would say the findings in the global financial crisis were similar to what hedge fund, how a hedge fund responded, and what we find in this crisis. That basically there's a lot of deleveraging. Yes, and so going back to the contribution, the second strand of literature that we contribute in is heterogeneity preferences of institutions. So there is by Koichen and Yogo, they developed a demand system asset pricing model to infer how the stock prices, or basically to estimate how the stock prices change when different owners have different preferences. And we contribute to this literature by looking into, there is a shock coming, and how do institutional investors respond to this shock? And the basic finding is that there's a flight to quality, to low leverage and high cash firms. And on the other hand, some, especially hedge funds, like engaged in a indiscriminate selling and a large sell-off. Then, okay, I see some more. Yes,
yep.
Please.
Simon Vikas has a question.
Mm-hmm.
He asks, why did hedge funds not take advantage of retail investors rushing into financially fragile stocks?
I don't know. That's a good question. I mean, the only thing I could, it's more a speculation than something that what we found is that, I mean, hedge funds have a lot of risk due to their leveraged model, and maybe they had to take care of their own, get rid of their own leverage, and had not so much money left or assets left to engage in and bet against retail investors.
Yeah, I think that's an interesting point. I think just jumping in, I think, I can imagine that, you talk about mutual funds holding cash as a response to do liquidity management. So I would imagine that mutual funds would be kind of more vulnerable to such kind of, investor redemptions. So it might be worthwhile to look at what, maybe you can also look at hedge funds, which are, I mean, leverage is difficult to measure for hedge funds, but maybe if that's the story, then you could look at, some cross-sectional variation across hedge funds. I mean, hedge funds are also quite heterogeneous, right? So it might not be that all the hedge funds are behaving in the same way. So
yes, yeah, that's a great suggestion. Indeed, we want to look more, especially into hedge funds. There could also be some short selling on the stocks that we could look into. So thanks for the suggestion.
Yeah, it's all the recent GameStop stuff is also kind of relevant, right? Because you just see like how, it's sort of a battle going on between the retail side, and the retail side has become quite active during the crisis period. So that's sort of related to my question.
Yeah. I mean, the GameStop example shows to some extent what risk hedge funds have when they bet against retail investors. So especially when there is an unprecedented crisis, as in the first quarter of 2020, hedge fund could just say, well, maybe this is too much risk, we stay on the sidelines. And at least from their behavior, we see that they are doing this. But I think it's important, and we will do this to look more into maybe some hedge funds. There's also some heterogeneity within hedge funds, and some hedge funds that do a different strategy.
Thank you.
I see there's a new question coming up.
Yep. Yehua asks, are the changes in institutional ownership during the COVID period due to changes by their investors or by their managers?
I'm not 100% sure if I understand the question, but I think if I understand this question correctly, it's is it driven by outflows, so that basically the investors have to sell, or is it because of the institutional manager who gets more risk averse, but not because of outflows of the manager?
Yeah, that would be my interpretation of the question.
Yeah,
as well.
I mean, it could come, the investor influences can come from flows. It might also come from something more like a change in the mandate or, hedge risk. So I may not withdraw money from whatever account or funds, but do something. That could be, I don't know whether that happens, but it could be more than flows. That's what I mean, right? In one hand, in one world where investors do nothing. I mean, when I say investors, I mean investors in those institutions. They don't have any changes in their preference or behavior. There's no outflow, but the manager is making all those portfolio adjustments. But in another world, it could be all caused by investors. I'm just curious whether you have anything to say about that.
Yes. So what we find is so one problem in terms of answering this question is that we use some 13F institutional holdings data. So it's more difficult to get a precise measure of flows. But what we do is we look at investors and see how many outflows did they have in the global financial crisis, in the great financial crisis. And what we found is that if you have a stock and the stock has owners that had a lot of outflows during the global financial crisis, then we notice that this stock performs worse. So, but again, we don't know if this is due to actual outflows in the same COVID crisis, or maybe it's some expectation of the manager that he expected the same what happened to him 10 years ago might happen again, and then they are more risk averse. But I would say it's more difficult to disentangle it. But I think that's an important thing. Maybe we can use more fund level flows or something to identify this channel a bit more.
Got it. Thanks.
Yeah. Then going back to the contribution, if there are no more questions. Yeah. Okay. So the third strand of literature we contribute to is obviously the COVID, all the papers on COVID crisis. And there are a lot of papers that looking at many different aspects. And I would like to mention one strand that is coming up that is on the retail investors in particular. So several papers looked at Robinhood investors, and the same what we do in the paper. And I will get to the Robinhood results in the later part of the seminar. But our contribution basically to this kind of COVID crisis is we try to get a perspective on the market participants during the crisis. How did the market participants, meaning institutional investors and retail investors, react? That is the main contribution here. So coming to the outline of the paper, as I've already said, we have 4 different questions, and the talk is structured around these 4 different questions. The data is straightforward, so we have firm fundamentals from Compustat and also stock returns. We use ownership data from FactSet. Then we complement the ownership data, institutional ownership data, by data on retail interest by Robinhood. So this is possible because Robinhood made the number of investors, the number of retail investors that hold a particular stock. They make this public, but this was only available during the first 2 quarters of 2020, and by now you cannot download the data anymore. And then the 4th data set we use is our ESG scores, and we use ESG scores from MSCI, and we use ESG scores from Asset4 to get some perspective on the soft characteristics on environmental and social aspects. And one important thing maybe, we only look at Russell 3000 firms, and we only look at firms that are non-financials, non-banks. So the first question is, how do institutional ownership, what is the relation between institutional ownership and the COVID stock price drops? And you saw this picture already. The main conclusion from this picture was that firms with higher institutional owners, with more ownership, performed worse during the first month, during the time when the crisis unfolded. And that was basically between end of February and beginning of April. And if we do a check where we look at international stocks, we basically find the same results. That this result that firms with higher ownership perform worse on the stock markets holds also internationally. So this is one of our main tables. And in this table, we regress the return in fever, meaning the cumulative returns in the fever period, which goes from February 24th to March 20. And we regress the cumulative returns in this period on different ownership variables and on firm characteristics, as well as industry fixed effects. And our main result that you saw already in the figure is in column 1, that there is a strong negative coefficient on institutional ownership, meaning that the stocks that were held by institutional owners performed worse. Of course, there is the concern now this could be driven by unobserved heterogeneity. And we try to address this by looking more into heterogeneity by investors. So for example, what we find is that more active investors, and especially more short-term investors, exacerbated the stock price drop. We find this also true for more domestic owners. So this is the third, fourth, and fifth column. And in the last column, we look at did owners we had a higher outflow in the global financial crisis of 07, 08. Did those stocks perform worse? And we find yes. So when an owner had large outflow during the last crisis, we find the same result in this crisis, that those owners, like the stocks, performed worse.
Simon, Vikas
Yes.
has a question.
Mm-hmm.
Yeah, so Simon, I had another question, which is somewhat different from the unobserved variable affecting both the left and the right-hand side of your regression. It's more to do with what causes what. So it's about more like a reverse causality, one way of thinking about it. So is it possible that, institutions are effectively timing in some way? And so essentially it's the other way around, where, institutional ownership, the returns are actually driving the institutional ownership, the expected returns. And so did you try to look at some change regressions, change on change? It's still not going to be perfect, but something like that.
We didn't look into change regressions. We try to tackle this problem by two ways. I mean, one way is that the action happened in a very short time window, right? So it's very difficult to, if investors, like basically if it's a reverse causality story, then investors had to pre-position a very, very large and fast stock price drop, which seems unlikely, at least to us. And in the second part of the paper, we look more into the holding changes over the period, over the full period, meaning the start of the January and to end of March. How did they change their portfolio? And we find that there's a huge decrease in ownership in these stocks. And I mean, there could be some day-to-day timing effects, but on the aggregate, we don't see this. When we compare the beginning of January to the holdings in, basically when we look at the ownership change in the holdings of the investors.
Okay, thank you.
Yeah. And one thing I want to mention is in the second column, we added the environmental and social score of the companies, because there were some papers that there was some debate on whether companies with higher environmental scores or social scores perform better. we find also that they had better performance when a company had higher environmental and social scores. And to talk briefly about some robustness checks that we did. So we checked that this and found that these results also hold in an international sample. We find the same results if we do not use the raw returns, but if we use the CAPM adjusted or Informa French adjusted returns. And we find that all these results are basically among smaller stocks, meaning stocks that were part of the Russell 3000, but that were not part of the Standard & Poor's 500 index. So it's more among these 2,500 smaller companies where we found these effects to be more pronounced. This also makes sense to us because in the larger stocks, you have a lot of index products, you have a lot of passive investors and high component that there's not so much like very inelastic demand.
Simon, I have a question.
Sure, please go
Do
ahead.
you see this negative return reverse in the following period? Is it purely a price pressure story, or is there some information or something specifically changed regarding the fundamentals of those stocks?
We see when we look at the second quarter and the effects, we find basically the same results. So we find that also that we find no correlation between institutional owners and stock returns anymore. But what we do find is that institutional investors still piled into low leverage and high cash stocks when we look at the portfolio changes and how they change their holdings. I hope that answers the question.
Right. So there's no reversal. If anything, this is so still we cannot differentiate whether this is a long-lasting price impact caused by institutional behavior change, or this is due to changes in the fundamental of certain group of stocks, right? We still don't know those two. I think it would be helpful if you can I think you have to have a longer time period in order to tease out this question.
So basically what you are suggesting is to look at the subsequent quarters and see if there are a reversal in the stock price. Because if it's like fire sales channel, then we should expect a reversal in stock prices in the following.
Right. If it reverses, then I think it's related to Vika's question whether COVID is causing something fundamental, some changes in the firm's fundamental, right?
Yes, I agree with you. Yes,
that will help to address that point.
Yeah, that's actually on our to-do list to look into this. Well, thanks. That's a great comment. Okay, related to this point, I want to show you some more direct evidence of fire sales that maybe also addresses this point of unobserved heterogeneity and maybe also reverse causality. So what we do here, we introduce two new variables. And the first variable is called high leverage IO. And high leverage IO, we characterize this by looking into the holdings of the portfolio of an investor. And then we see, is an investor holding a lot of high leverage companies in their portfolio? Meaning, do they have a high exposure to high leverage firms? And we basically find if a firm has a lot of owners with high leverage firms in their portfolio, then we find a more negative response to leverage in the company. So meaning that if you have an investor who is heavily exposed to company leverage, then those investors are also more likely to sell, and we find a strong stock price decrease. So this is, we believe that this is more difficult to reconcile with other explanations, especially with unobserved firm characteristics, because you would also need to have a story then how this relates to the portfolio and to the portfolio composition of investors. So that's in the second column. That's where we look at the interaction between high leverage, IO, and leverage. And in the fourth column, we do the same. And we look at investors who hold a lot of companies with low cash. And then we see how do these investors respond to to when the company has more or less cash, and we find that these effects of piling into high cash stocks, or like basically here what we look here is that you have a better stock performance. It's much more pronounced if you have a lot of owners who have low cash, and then if you're a high cash firm, then you experience much better stock returns over the fever period. And we interpret these kind of interaction effects. We interpret them as fire sales externalities and a dash for cash, that basically they try to get rid of too much leverage stocks in their portfolio, and they also sold low cash firms in their portfolio. That especially when they had a high exposure to those stocks in ex ante. And we support these kind of findings later when we look at the actual portfolio changes. So that was on the part on the stock returns, but as you said, there could be alternative explanations. So now we're looking more into changes in how the investors changed their portfolio composition over the first quarter. And there we go in the 13F holdings and look at the actual changes. And the first observation that we make is, in this graph, we compare the change in ownership in the first quarter of 2020, which is in red, to the changes in institutional ownership in green during 2009, the fourth quarter. And we find that the ownership change in the first quarter of 2020 was highly negatively skewed. And we find that there's a lot of unusual selling activity. They were selling, decreasing institutional ownership in many companies, and that's to a much larger extent than what you would have seen what you have seen in earlier periods, in earlier quarters. And just to quickly make this point is on the right hand side we see earlier quarters, and they are all centered around 0. But on the left you see the red distribution, meaning the ownership changes during the first quarter of 2020, and we find that basically they are skewed, like there's this centered around the board to the left, and that shows there's some unusual selling activity. And here we come to a regression where we move to a multivariate analysis. And on the left-hand side, we have the change in institutional ownership in the first quarter of 2020. And on the right-hand side, we have a couple of firm characteristics. And here, what we try to find out here is, how did institutional investors change their portfolio during the first quarter? Was there a flight to quality? And if yes, how did quality look like? Was it a hard financial resiliency, meaning high cash, low leverage? Or were investors also interested in companies that had a good environmental or social score? And what we basically find in the first column is that leverage is negatively correlated with the change in ownership, and cash is positively correlated. So we find that investors repositioned themselves toward more low leverage and high cash firms. And then in the second column we control for the past level in ownership, and we see that especially the result on leverage is very robust. The coefficient on cash reduces a little bit, but the coefficient on leverage is very strong. So we see that institutions positioned themselves more into low leverage companies. And one important thing that I want to mention is we also control for stock illiquidity in all these regressions, because basically we know that institutions have a preference for liquid stocks, and that's something that we control for. So we measure stock illiquidity before the crisis and see if there were some changes. So the overall conclusion, and on the third column, I forgot to say something about the third column. The third column looks into environmental and social, and here we have a lower sample size, so we do some observations. but basically we do not find a result on environmental and social. And our interpretation is that basically we have that basically institutional owners show a preference for hard financially resiliency and not for soft characteristics. I see there's a question coming up.
Yeah, Vikas asks, why are institutions buying more illiquid stocks?
That's a good question. It's hard to say. Yeah. So looking into the figure to the right, the three figures, you see the same what you saw in the regressions, but you see it more in the bin scatter plot, and the same. We find the same result. That basically, the ownership change in the first quarter is more like has a negative correlation to leverage and a positive correlation to cash. And we do some robustness checks on and the first robustness check is we look at passive ownership, and of course we do not expect any changes on passive ownership. And we also do not find any changes, like we do not find the passive owners move into leverage or cash firms. And then we also look at the changes only for S&P 500 index. So we restrict the sample to S&P 500 companies. We basically find that all these results that we notice here, that the flight to quality is stronger, or is basically stronger in the smaller stocks, in stocks that are not part of the S&P 500, but still in the Russell 3000. Okay, okay. There seems to be no more questions.
Sorry, Simon. I just direct messaged Vikas and Pedro. Let me just publicly air that direct message. In response to Vikas's question, one thing I thought might be going on is that rather than buying illiquid stocks, they may just be holding those and selling the liquid stocks, which are easier to sell. And that might be driving this positive coefficient on the stock illiquidity. And Vikas in response said that would be consistent with the fire sales story.
Mm-hmm. Okay, thanks for mentioning this. So now we look more into the different, like we try to look into different heterogeneity among institutional investors to find out how different types of investors, like how did the preference of different types of investors change. And we split the institutional ownership into 4 different groups: hedge funds, pension funds, mutual funds, and investment advisors. And the main interesting finding that we have here, or like two interesting findings, is, so when you look at the figure on the right, in the figure we try to see how much did the total size of the equity portfolio change in the first quarter when we keep the stock prices constant. So we move out, we assume on no stock price changes. How did institutional owners change or reduce their total portfolio size? And we find that hedge funds basically sold $100 billion equities, which is almost 5% of their total assets. So we have a large deleverage effect of hedge funds. And if we look now to the table on the left, in the first and the second column, we find that hedge funds, we find no flight to quality, meaning flight to low leverage, high cash firms for hedge funds. We only find that they engaged in an indiscriminate selling. They tried to sell more or less everything, and they were also among those investors that reacted they had a very strong response to the pandemic. On the other types of investors, especially for pension funds and investment advisors, we see this kind of move more towards quality stocks, meaning low leverage stocks. And one interesting finding on pension funds, especially, which are usually seen as long-term investors, we find that pension funds also reduced their ownership in companies that had a good environmental and social score, which is a little bit opposite to what previous papers find on pension funds. Okay, so the main conclusion of this slide is that hedge funds engaged in indiscriminate selling, whereas the other types of investors, especially pension funds and investment advisors, they moved more to quality stocks and did not reduce their equity, the total size of their equity portfolio so much.
So Simon, I have a question, and it has to do with a couple of things that are mentioned in the chat. So first, there's a comment from Byung Kang that there's this paper in RAPS by Pastor and Vorsatz that shows that mutual fund investors do not sell mutual funds with high ESG ratings as much during COVID. And then there's evidence in your paper, as well as I think evidence in Dotling and Kim, that suggests a lot of investors sold ESG stocks during the COVID crisis. How do I reconcile these two things? Are these just, because to me they seem just opposed to each other. Is there a way to reconcile them?
Yeah, I agree with you. There's some debate on like what happened exactly to ESG funds. We do not find any evidence that institutional investors move into into stocks with high environmental and social scores, and we also find the same for retail investors. So retail investors also do not show a high increase or like do not move into environmental or social scores. So we do not find. On the other hand, we also do not find like that they move very much out of these stocks, like only maybe the pension funds. So maybe we have some kind of a middle position here.
Okay, thanks.
Okay, then so far we looked at the institutional ownership changes, and now the natural question is like, who took the opposite position? And we know already from institutional investors that usual approach to get retail ownership is to take the difference between 100% and institutional ownership, and then you get an approximate measure for retail ownership. And we know already if institutional investors decrease their position in many stocks, then we know that retail ownership relatively should have increased. I mean, there are some insiders and other groups of investors in this 1- total ownership. But to some extent, we can assume that already we know that because institutional investors decreased their ownership in many stocks, we know that retail ownership should have relatively increased. And to identify this more and to see if this actually holds, we look at Robinhood users and bring some more data, some more direct data on retail investors, and see how the changes in retail interest affect the stock prices and the ownership composition. So I think I don't have to introduce Robinhood very much because it was strongly present in the news. That basically it's a trading app for that you can use on your phone, and it had a lot of users at the end of 2019, about 10 million users. And the interesting part of this app is that it's a commission-free trading app. So retail investors, especially because they had because of the money of the government, they got the stimulus checks, and because of there was not so much to do, it has led to a very large increase in Robinhood trading, and the trading increased very much over the last year. And to see how the retail interest, so what we do is here we look at the percentage change in the log Robinhood user number. So how did the number of users that hold a particular stock change? And we plot this change versus the change in institutional ownership over the first quarter in 2020. And we basically find a negative correlation. So meaning if an investors sold the stock, then this analysis or this figure suggests that Robinhood retail investors' interest spiked. And on the right-hand side, we do a industry by industry analysis and look if these are some industry effects, but we do not find many. We find basically that in all industries or most industries, institutional owners decreased their ownership. That's the blue bars, and retail interest by Robinhood spiked. That is the red bars. So we basically conclude that retail investors took the opposite side of the ownership trades, at least in the aggregate level when we look over the first quarter and we look in the actual holdings. And now we do some more multivariate regressions, and we see how did the retail interest change when we regress the retail interest change on firm characteristics. And the findings are basically opposite of what institutional owners of what we found in the ownership regressions of institutional ownership, and that is retail interest increased for high leverage firms and it decreased for low cash firms. And this result is very robust. It holds also when we control for the past level. And we also, in this regression, we also have the same number of and the same controls as in the previous regression. They're just not shown here to save some space. And when you look at the third column, in the third column, we added the environmental and social score. We see some, the coefficient is negative. So there was some decrease, but this result is not as strong. What I will show you, because I will show you this here in a minute. So here we do a day-to-day analysis. We look at the evolution of the coefficient of retail interest and how retail interest changed when regressed on cash, leverage, and how do the coefficient change when you increase the window of retail interest change. Because the interesting feature here is that retail interest change is not only available for the full quarter, but it's available for each day. So we can see what happens to the holdings of retail investors when we increase the window over which we do the regression. And what we basically find is that on the left, on the middle figure, is that they pile into high leverage companies and into firms with low cash holdings. But on the right, we have the environmental and social score. But you see on the gray lines, which are the confidence interval, you see that those are not as strong as the other two figures. There's a higher variation on the coefficient, the higher standard error. So the main conclusion from the retail investors was that retail investors basically took the opposite position during the first quarter of 2020. And now we ask what happens in the second quarter of 2020. Was there a reversal in trading? Because we know from the stock markets that the stock markets recovered, stock prices recovered on the aggregate. But this holds especially for some stocks, especially tech stocks, not so much for other stocks. So we are interested in how did institutional investors change their portfolios? Did they reverse to the old level? Did they buy back the stocks that they sold? Or do they continue to pile into high cash and low leverage firms? Like basically we asked, do they stay risk averse or do they change their portfolio back to what they had before the pandemic started? And the main finding that we have is, so when you look at the figure on the right, which shows the change in ownership in the second quarter in yellow, and compare this to the change in the first quarter in red, you see that there is some buying activity. The distribution is a little bit shifted to the right, but the distribution of the yellow bars is very wide, meaning there were some stocks that had large increases in ownership, and there were some stocks that had very large decreases in ownership. And we tried to find out more about this by looking into do some more multivariate tests. And basically the finding that we have here is it's the same, meaning we still see a negative coefficient on leverage and a strong positive coefficient on cash, meaning that institutional investors still move into high leverage and into low leverage and high cash firms in the second quarter. And so they did not reverse their preferences, did not change their trading. And we find the same result on environmental and social. So there's there's no increased or decreased interest in stocks with high ES scores. We get the same results when we look at the figures and the univariate figures. And just to highlight one figure is the figure 6, that's the top right figure. There we plot the change in the second quarter and ownership change in the second quarter to ownership change in the first quarter. And we find basically a strong positive correlation. Stocks that had an increase in ownership, they still have an increase in ownership. And then the natural question is, of course, what happened to retail investors? Did they also continued showing the same preference, or did they change their preferences in the second quarter? And we basically find that they still move into fragile stocks. They still have the opposite position, the complementary position to the institutional counterparts. And yeah, that's so we basically see that in the second quarter of 2020, there is no reversal in the terms of preferences when it comes to institutional investors or retail investors. And to conclude, we have, in the paper, we examined the behavior of investors when a tail risk event realizes. And we looked at the COVID pandemic because it's a kind of a perfect exogenous shock that did not originate from underlying changes in the economic conditions. And our main findings are that institutional ownership amplified the stock price drops, especially when they are more exposed investors and they're more short-term investors, and they had more companies with high leverage in their own portfolios, then we see a large stock price drop. That's the first part of the result. And then the second is that for those investors that did not engage in an indiscriminate selling, we find a flight to safety, a flight to quality, to stocks that have high cash and low leverage, meaning these companies have hard financial resiliency measures. We find less evidence for soft characteristics. And when we look at the ownership changes and the portfolio changes in the first quarter, and we find that the institutional ownership were the marginal investor, and this indicates some demand price pressure. And basically looking at the retail investors, which you can see by using 100% minus ownership, or when we look at Robinhood trading proxy, we find that those retail investors took the opposite side of the trade and they provided liquidity. And coming to the second quarter and seeing if there is a recovery or not, we find that both institutional owners and retail investors kept expressing the same preferences. So institutional owners were still very risk averse in the second quarter of 2020, whereas retail investors were more interested in stocks that had a high leverage and low cash. And one natural question that comes up from our paper, of course, is what do these changes in preferences that we notice for institutional owners, how does this affect the corporate sector? What are the real effects of these kind of price flows and of the fire sales? What is the real effect? And did it affect the companies in a way? Did it exacerbate the company's financial situation or not? We think that this could be a very interesting future research for future research project. Yeah, is there any more questions?
Wonderful, Simon.
So I had a question which I was typing.
Okay, sure. Go ahead, please.
So I think this is very interesting that you showed that the stock returns actually pattern changes after the COVID, right? So if you go back to your slide, um, where you show that,
This one?
no, yeah, this one. So you see that the stock returns are actually going back up, but the institutional holding pattern doesn't change, which
Exactly.
kind of makes it quite interesting to understand. Like, it sort of goes back to what's really driving the stock returns, because for every trade there is always the other side, right? So so I'm just trying to understand, like, how can we understand, is it simply that institutions have a certain preference, and but the stock returns are just like a show going on the side, or there's something that's, so I'm just still trying to understand that,
Mhm.
and how should we think about it?
So if like to provide some, maybe some, I mean, one thing that drive, we know that the stock price recovery in the second quarter of 2020 was very much driven by large companies, by, for example, Google, Facebook, Amazon, they all performed very well. So we had this effect that they, like 5 or 6 companies, like they had this huge increase in stock prices and the rest not so much. So one way to reconcile these findings is we look at the average effect when we look at the changes in ownership, but maybe the stock recovery is located in 5, 6 super large companies, and then you could see the recovery in the stock prices driven by 5 stocks, 6 stocks maybe. On the same hand, on the other side, you still find the changes in the institutional owners basically preferred stocks with more cash and less leverage.
Yeah, I think that would be interesting to see, sort of maybe exclude those big stocks and then see if that helps in
Yeah, we did
explaining.
some robustness checks on this, and we find that the results basically hold. So
Okay,
yeah, we did this. Thanks for your comment.
thank you.
Okay. So I'm going to stop the recording. Thank you, Simon, and thank you everyone for attending. If you have any other questions, feel free to stay around, and I'm sure Simon will be here.
Yes, thanks so much for having me here, for listening.
You're most welcome.